Meta and tech stocks in general have been performing well recently as the stock market witnesses a rally in these sectors. The Meta platform stock has been on an upward trend so far this year, with a remarkable increase of over 40%, a rebound that began in November of 2022. And despite the skepticism this surge has attracted, there is no denying the ongoing revival in the technology sector sparked by the Facebook parent. Given these developments, one may wonder if the rally has run its course as the company moves towards its long-term goal of transitioning to the metaverse. Or are Meta and other tech stocks still a worthwhile investment opportunity now? Welcome back to the Millionaire Mindset. Be sure to subscribe to the channel so you won't miss our important upcoming videos. In March 2020, the COVID-19 pandemic brought widespread economic disruptions, making it challenging to forecast the future of tech companies. On one hand, some tech firms faced immediate negative impacts, such as a slowdown in revenue growth for Alphabet and Meta due to decreased advertising spend from companies like travel and hospitality that were severely affected by the pandemic. On the other hand, the insatiable demand for PCs, smartphones, and other gadgets created a thriving environment for tech companies like Intel, Microsoft, and Apple. This can be attributed to a combination of factors, which included the limited options for consumers to spend their money. However, the year 2022 marked the start of the end of the pandemic-fueled prosperity, as high inflation prompted the Federal Reserve Board to rapidly raise interest rates, putting pressure on consumer spending. And let's not forget Facebook's shift to virtual reality and the metaverse by changing its name to Meta Platforms. Now, while there was a slight recovery in sales, the challenging economy in 2022 and privacy changes from Apple on iOS devices presented new obstacles. And though Meta is still investing billions of dollars annually into its metaverse endeavors, it still has little to show for it. Notwithstanding, the tech giant has been growing significantly in the past quarter. In fact, its share price has gone up from $88.09 in November to $182.85, which is more than a 100% increase. This recent rally was further boosted by its recent earnings report, which has allowed its shares to reach levels not seen since last summer. The Facebook parent company even went further to beat revenue expectations by $480 million and announced a $40 billion share buyback program, contributing to a $90 billion increase in its market value. The company also predicts its revenue for the first quarter of 2023 will be between $26 billion and $28.5 billion, which is more than the expected $27.25 billion predicted by analysts. Other tech companies like Snap Incorporated, SNAP, Pinterest, PINS, Apple, AAPL, and Microsoft, MSFT, which are all worth over $1 trillion, have also seen an increase in their shares. Additionally, it seems that Meta's primary social media operations have regained momentum, as evidenced by the increased monetization efficiency for Reels, the short-form video platform on Facebook. The Reels monetization rate, which has also doubled, is now projected to reach break-even by the end of 2023, as the company likewise reported a growth in its daily active user base on Facebook, with a record of 2 billion users compared to the previous quarter's 1.98 billion. Meta Platforms CEO Mark Zuckerberg has referred to 2023 as the year of efficiency, as it has revised its expenses plan, reducing it from the previously projected $94 billion to $100 billion to a new range of $89 billion to $95 billion. This change is attributed to several factors, including the 11,000 job cuts announced in November, the discontinuation of non-essential projects, and the reduced spending on the construction of data centers. As good as all this sounds, there remains concerns and questions about Meta's future uptrend. Despite the stock's 54% rise since last November, it still trades at significantly lower valuation compared to its average over the past decade, and is considered one of the most inexpensive stocks in the Nasdaq 100. This is mostly because Meta's shares still remain well below their all-time high from 2021, and analyst predictions indicate only a modest 7.7% increase in the stock price come 2024. In light of the above, investors therefore need to be given more clarity regarding key challenges the company faces. One such challenge is that which the company faces from competitors such as TikTok and Apple's privacy policy change, which is expected to cause a revenue loss of $10 billion for the year. One way Meta can therefore hope to maintain its upward momentum would be to address these challenges and provide a clear plan of action. Now, Meta isn't the only one hit with competition, as Alphabet hasn't had it rosy either. While Alphabet's Google Cloud business is growing rapidly, its advertising revenue has also declined as its subsidiary YouTube struggles against the competition from TikTok. Advertisers are also cautious with their spending due to economic concerns. Nevertheless, the company has emphasized its priorities and is exploring new methods to generate revenue from YouTube Shorts. Then there's Netflix, who is also currently sitting at this table. The streaming giant, which amassed subscribers due to the pandemic, experienced a purge, partly due to increased demand and an array of high-quality alternatives. For one, the introduction of Disney Plus and the growing popularity of HBO Max, along with numerous smaller streaming services, presented consumers with more options than ever before. And as a result, Netflix has had to adapt and shift its stance on ad-supported plans while also working towards cost-cutting measures. So, considering the poor performance of these stocks, even up until last year, is this then a good time to buy, especially with the recent recovery we are seeing in the market? Now looking at the stocks of the leading tech companies known as FANG, Facebook, which is now Meta, Amazon, Apple, Netflix, and Google, which is now Alphabet, all have experienced a drop in 2022, as mentioned earlier, despite being profitable and having a favorable long-term outlook. But if we are to follow the advice of renowned investor Warren Buffett, the best time to invest is usually when the market is uncertain and prices are low. Following this line of thought, the majority of Wall Street analysts have a bullish outlook on Meta, with 41 out of 57 analysts surveyed rating the company either as a strong buy or a buy. Out of these 41 analysts, 29 have given Meta a strong buy rating and 12 have labeled it as a buy, with the average price target being $204.63, indicating a potential 11% increase from its current price. On the other hand, 12 analysts view Meta as a hold, with 4 analysts having a bearish stance. Coming to Alphabet, its current stock also has a lot to offer beyond its dominance in search and the expansion of YouTube and Google Cloud Platform. The most attractive aspect of this company comes in the form of its 10-year low valuation, which has prompted management to engage in share buybacks. This move is expected to benefit long-term investors by reducing the number of shares in circulation. Alphabet's stock, represented by Google, GOOGL, has also risen over 18% in 2023 despite facing numerous challenges. Added to this, Google also plans to offer its own generative AI tools to software developers in an effort to counteract Microsoft's investment in OpenAI. So with a combination of robust growth, an affordable valuation, and returning of cash to shareholders, this could just be an ideal moment to add Alphabet to your portfolio. And as for Apple, it's still considered a long-term investment opportunity regardless of a 25% stock dip from its all-time high. The company's plans to broaden its product portfolio with a foray into the rapidly growing virtual and augmented reality markets also seem to bode well for investors. According to reports, it's likely that Apple will launch a mixed reality headset with both VR and AR capabilities in 2023. And according to Grandview Research, the VR market was valued at $21.8 billion in 2021 and is expected to grow at a compound annual rate of 15% from now until 2030. But going by the company's good record of entering new markets and quickly becoming dominant, this new product of theirs therefore shows good potential. Overall, investors who are seeking to invest in tech stocks due to their current low prices may want to consider a gradual approach, according to Liz Young, head of investment strategy at SoFi. Then there's also the uncertainty present in the market, which would require a strategy of averaging in to take advantage of potentially better prices that could come in the near future. With this strategy, long-term investors can still be guaranteed a benefit from the opportunities in the tech sector while also minimizing the risk of short-term volatility. Mark Zuckerberg has finally made a statement that has pleased his investors with his recent promise to prioritize artificial intelligence development at Meta. This development is not really recent. Just like other big tech companies like Google, Meta had actually been early on in the development and use of AI. The only difference is the company did not make it accessible to the public. Meta unveiled Galactica 2 weeks before ChatGPT was introduced to the world in November 2022. The Galactica program was designed for scientific research and could write articles, solve mathematical problems, generate computer code, and annotate images. However, like ChatGPT, Galactica was not always accurate in its responses. One funny example was when it asked who runs Silicon Valley, and Galactica replied with Steve Jobs. Also earlier in the year, Meta released BlenderBot. However, it was not well received due to the company's efforts to ensure it would not produce any offensive material. As a result, it was described as stupid and boring by users. Meta now uses AI technologies developed by the researchers behind BlenderBot behind the scenes for ad targeting, content recommendations, and identifying problematic content. Now Meta must figure out how to turn its AI technology into a product. So for now, those looking to buy tech stocks should consider taking a long-term approach and diversifying their portfolio as the sector faces headwinds such as rising labor costs, declining advertising revenue, and increased scrutiny from rising interest rates. And while these challenges may sound unfavorable, they can also present opportunities for investors with a 2-year or longer time horizon to purchase these stocks at more attractive prices. To stay updated on developments in this space, subscribe to the channel. We promise you top-notch videos like this. And don't forget to give this video a thumbs up. Thanks for watching, and see you in the next video.